Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is your Course to Retirement, your resource for a common sense approach to planning for your financial, your investment, and your retirement future. Grand Rapids is the team from Cornerstone Retirement Partners and founding member, CFP Certified Financial Planner Ron Corser here with us, providing the guidance and direction. And Ron, on this week's program, it's that time of year, everybody's favorite time, a topic we all love to tackle. Taxes. It is what's going on in the financial world right now. We're probably getting those forms in the mail, and we're also probably paying a little bit of attention to the market here recently. But taxes are something that we have to face head on, aren't they?
Yeah, taxes are probably the topic of discussion here until around April 15th or so. And it's an interesting conversation to have because sometimes people treat talking about taxes as if we're talking about werewolves and vampires and things like that. And other times people really, because of the advice they're given, I think at times don't pay as much attention to taxes and the impact it has on their investment and retirement plans that they probably should, if I could use that word. So it's a good discussion we're going to have today. Taxes along with lions and tigers and bears, oh my. So everybody stay tuned. If we're going through the program and you're listening to us on your way to church, be blessed and drive carefully. You can tune in onto this subject here on today's program by going to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Or you can also just give us a call if you hear something right away that kind of gets your interest. Call us at 616-301-2581, 616-301-2581, and we'll help you. Now, full disclosure, I'm not a CPA, but I know a little bit about taxes just because of the way our firm has helped people in the past. And also, I'm a certified financial planner, so I'm actually required to know a little bit about taxes and the impact of taxes on people's retirement plans. So we're going to talk about tax season, if you will, today. And one of the things that is normal, I go back to my mom. I love her dearly. She's long since passed away. Her whole idea of taxes was to not have to pay at the end of the tax year. If she got a refund, she figured she had been successful in managing her tax burden. And at times I would try to say that's not exactly true, but it was my mom and I wasn't going to argue with her about certain things.
Well, I think a lot of people think like that though, Ron.
Yeah, and it's a normal response. I got money back, so life is good. I had to pay and life is terrible, oh my goodness. And what we want to talk about today and throughout today's program is a simple concept. It's called tax planning as opposed to what we call tax reporting. What do I mean by that? Tax reporting, we're all starting to go through that. We're getting our 1099s and our 1099Rs from taking money out of our retirement plans or the capital gains distributions and things like that on investment accounts that are taxable. And we're taking them to, if we don't do our taxes, we're taking them to the tax person and we're saying, here, make it go away, fix it. The other part is tax planning. And today it marks really an opportunity for us to think about the concept of tax planning. We know about tax, just here's the tax, what do I got to pay, or hope I get money back. But once we take a look at what the taxes are and what we're going to pay this year, what a great time, because we have a lot of time left in this year, to do something called tax planning, tax forward planning. What do I mean by that? If on your tax return, ladies and gentlemen, when you get it back, you talk to your tax person, or if you do your own, if you have dividends, interest, capital gains that are taxable events that have been given to you with what's called a 1099, it may be a good idea to look at what can we do to reduce that for 2022 tax season. Just taking a look at it, it may be possible to shift some things around so that that's all taxable income to you, ladies and gentlemen. The dividends, interest, capital gains, it's offset by losses. But basically, it's almost, we call it phantom income, because for most of us, we never spend that. We just have it reinvested or sitting in a cash account. But it's a taxable income account to us, and it's a taxable issue. So number one, looking at that may be a place to start to say, what can I do in 2022 to reduce what I pay in tax? A second thing we can look at is to say, well, I got all this money in my IRA and 401k because that's how I was told to save. And I get that. Now the question becomes, all right, if you're starting to take money out of those accounts, how much are you taking out because you have to for income? And what are you paying in tax? Because once you know that, then you can ask this question of yourself or your tax preparer. Is there something I can do now that will help me pay less tax down the road in the future, 5, 10, or 15 years from now? Because it's just my opinion, ladies and gentlemen, that what we pay in tax in the whole tax world that we live in is going to change dramatically over the next 5 to 10 years. Think about everything that's going on in our government. I mean, they're spending and printing money like drunken sailors. We're increasing all the benefit and welfare payments that are going to require more and more printed money to make sure they still keep working. We have strange things going on with how the money is doled out, and we have this enormous $30 trillion debt that we'll never pay. Those are all bad news things. The question is not to kind of agonize over them, although a lot of us do. The question is, okay, if that's the reality that I'm facing today, what are the things I can do to help me down the road? Because, you know, when we're working, taxes kind of come out of our paycheck automatically, and we don't give it a lot of thought. But when we're retired, taxes become one of the number one items that we always see, because we all of a sudden start taking money out of our IRA, and all of a sudden we take it out, less taxes. So we take $1,000 gross distribution, we get $750. That we're faced with the tax issue right away. When we kind of come and see my wife Nancy for her Medicare review in the fall, and Medicare prices have gone up and Part B prices have gone up, we see that comes out of our Social Security benefit. So we're more aware of the taxes and cost of retirement. And so the question is now, okay, we're filing our taxes. What can we do going forward in 2022 to minimize, if possible, what we pay in tax to reduce the cost of just living? And that's what we're going to talk about in today's program. We're going to do a little bit of a deep dive, and we'll also do kind of a 10,000-foot view of some of the things. But again, it's always an individual situation. So ladies and gentlemen, if you're interested in getting a little bit of advice on some options for dealing with taxes, whether it's taxes in retirement, taxes pre-retirement, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. You can put your information in there, or if you'd like to listen to the entire program again, if you listen to all of it today, or you can't listen to all of it, you can tune in, get caught up with what's new, what's improved, what's not improved in the world of taxes, and perhaps get some ideas on what you might do.
Ron, it seems to me like there are a couple different types of taxes, actually many, many different types of taxes, but there's tax on income as we are earning money, and then there is tax on investment. And with the tax on income, we pretty much have very little choice and option. That's kind of set. The income is what it is, and we owe our taxes for what we earned last year. Whereas tax on investment, there's actually a great deal of ability to have control over what that ultimate tax liability is going to be. And it's no person's moral, legal, ethical responsibility to pay more than our required minimum, than our legal responsibility. And yet the way that we're taught to handle our money, specifically our investments, many of us do end up paying more than the moral, ethical, and legal minimum responsibility.
I'm smiling because when you said that, I'm reminding what Warren Buffett has said on several occasions. He's done pretty well in his life when it comes to making money. And he said a lot of times that his tax rate is much lower than his secretary's tax rate. To which I respond, number one, pay her more.
Yeah.
Number two, if you feel like, you're guilty because he gets all of his income from capital gains. And that's taxed much lower than income. So he can have a $10 million income. And because of capital gains tax, he's going to pay at most 25%. And my response to when I hear them on TV talking about it is saying, you know what, if it'll make you feel better and reduce the guilt in your life, just send another $10 million check to the IRS. That'll make you feel better. But for us normal folks, what I call us normal folks who don't live in that rarefied air, taxes are a really big deal. Because if you raise the taxes that Warren Buffett pays, his lifestyle does not change. For all the money he has, he really has a modest lifestyle. He drinks Coca-Cola every day and eats string potato chips, I've been told, and not much else. And he's lived for a long time. But for us people in America, most of us, when taxes go up, when what we have to pay in tax goes up, it can be a real problem. It can impact our lifestyle. And keep in mind, we're going to focus on income taxes here because we have some control over that. But think about all the other taxes we pay that impact our income, over which we have no control, really. Gas tax, sales taxes, real estate taxes, taxes on investments, things like that. There's a whole world of taxes out there. And I bet if we put a little arithmetic to all of it, I think we would be shocked and perhaps start a revolt if we really understood how much we pay in tax, because it's a whole lot more than just what we pay on our income. So one of the key questions for us to ask, ladies and gentlemen, starting today, 2022, February, beautiful February in Michigan, where the sun never shines, snows up to our ankles and above our knees, depending on the day, and there's no wildlife out there at all. The question is, what's the most important question? What do I want to do about what I pay in taxes going forward? It's not a question of, do I think taxes are going to go up? Because I think most people would say that. If you ask the question, do you think taxes are going to be higher, the same, or lower 5 years from now? Most people respond by saying, I think they're going to be higher, particularly the income tax. I would agree with that. So then a key question is, what is it you plan on doing about that? And generally, that's where people kind of run into a little bit of problem because they don't know what the options are. But there are options. There really are options. Now, there's no free options, but there are some really basic options, and we're going to talk about some of those things that people can do that will help them next year, 5 years from now, 10 years from now, manage the tax cost of their life and their retirement plan. So ladies and gentlemen, if I've said this in a way that interests you, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there. And also, if you want to hear this program today, again, you can go to our website, tune in on the blog, and you can take notes if you want. So the key question, as I see it, it's not that our tax is going to go up, but what are we going to do about them? What are we going to do about them? I know every year, a lot of our clients come in and talk to my wife, Nancy, when she does the Medicare sign in and all of that stuff, enrollment. And one of the key questions they always ask her is, can I reduce the costs of Medicare and or Part D, the drug program? It's a very rational thing to ask, isn't it? can I reduce the cost? But sometimes we don't ask that question of our advisors. How do I reduce the cost of living in retirement, of taxes, because it's a cost? So one of the things I suggest people do, we can help with this. If you've got a tax person, you can do this after tax season, is ask them to help you reduce costs over the next few years. What are the steps specifically you can take to do that? Whether it's a Roth conversion, whether it's investing in different kinds of funds or exchange traded funds in your taxable accounts, what can you do? And ask them to help you with that. And if they don't have great answers, give us a call, 616-301-2581. We've got some what I think are pretty good answers for some of these questions, and we can help you plan the future in terms of how much you want to legally give up your retirement planning to taxes, both for federal, state, and local. So give us a call at 616-301-2581.
Ron, you mentioned that if asked, you believe that most people would agree, or that most people believe that taxes will likely go up into the future over the next several years. But in fact, don't we already have some laws on the books that if nothing else is done, taxes will be increasing into the future? Like, that's already a bit of a certainty unless further action is taken, correct? And it's not a huge jump, but it is an increase from current rates.
Yeah, part of the 2017 tax bill said that all the new tax rates, because the brackets went down and taxes changed, if nothing happens at the end of 2024, it's going to revert back to where it was in 2017. So even if the government doesn't do anything, because it's an election year or whatever, they've got their eyes on other things, the tax issue we face is going to cost us more money going forward if nothing changes. So it's really important now, because we have an opportunity to do something about this, to say, what is it we can do? How are we going to do it? Because if we think about it, when we're working, what do? We pay taxes, we pay bills, we spend our money, and then we save. When retirement comes along, that gets reversed, because we've been taught to save in tax deferred accounts. What is it we do? Number one, we pay bills with taxes. We pay taxes first. Secondly, we spend it. Third, we buy stuff. It's pretty simple in retirement. You know, as long as we're happy with paying all kinds of taxes to the government legally, I guess nothing should change. But there are things we can do, and that's what I want to talk about it, because retirees are probably more aware of taxes than non-retirees, simply because of how we save, how we invest. We know that. So it gets down to a couple things, and I talked about it earlier in today's program. There's a difference between tax filing and tax planning. Tax filing is what we're all doing right now, collecting all of our receipts, all of our documents, all of our 1099s, all of that stuff, saying to the tax person, fix it, make it go away.
And tax filing, Ron, does have a season. You mentioned it's tax season earlier, and I meant to just interject there a little bit and ask a question. Is there really a tax season? For filing, yes, there is. But for tax planning, that's kind of an ongoing, evolving, not really confined process. That doesn't necessarily have one distinct season.
No, it's not seasonal at all. It's ongoing. And if it's done well, I won't say properly, but done well, it's a constant thing that goes on in our life. Sometimes I encourage people, if they don't do their own taxes, to pay their tax preparer some money to help them with this. To say, look, I want to make this one investment decision. What's the tax implication? I want to start taking my money out of my IRA and convert it to a Roth. What's the tax situation? The tax preparers that you have, be more than happy for you to pay them a few dollars and have them do the analysis. We do it for our clients at no cost, because I think it's important for clients to always see the potential tax ramification of any kind of investment decision or savings decision in black and white. It's not saying, well, I don't think this is going to be a lot in tax, and it could be a surprising issue. So we do a lot of what we call tax planning with our clients, particularly in the area of taking money in from an account that's going to be taxed forever and probably to death IRAs, 401ks, those kind of things, and converting it into a Roth. Now, I'm not saying that a Roth conversion is right for everybody, but it certainly is right for everybody to look at it, to see if it makes sense for them. Because if we think the tax rules are going to change, and we said earlier in the program, even if nothing happens, they're going to change in another 2 years or so. Maybe it makes sense to look at that and what's a rational way to take it from it's going to be taxed forever to never taxed again. So it's important to do that. It's important to make a decision when it comes to planning in retirement, when we plan for income. We've had to emphasize on this program a lot. The most important part of retirement planning is planning income in retirement. Sometimes we take a look at it, and it's normal for human beings to do this. Well, I've got $500,000. If the market keeps going up 7%, my money is going to double every 10 years. That's one way to look at the income issue. And we're in a market now that's really gotten ravaged, so to speak. So sometimes that planning gets a little scary. It's much more rational to say, I need to figure out how to create an income plan in retirement that'll give me the income I need to stay retired. And that can include Social Security, pension plans, which can be taxable. They're not free. They can be taxable. And how do I take money out of my different accounts, IRA accounts, taxable investment accounts, bank savings accounts? What's the best strategy to put all that together? That's where we can be a great help to our clients and to anybody who's listening to this program. We can help create that income plan. And it's based on a really simple idea. We're going to pay tax. The question is, over time, are you going to manage the taxes like you manage income in retirement? You know, if you have $10,000, Peter, because I know you got a pretty awesome lifestyle in retirement, and you need to spend $10,000 a month to live, and all of a sudden you start spending $25,000 a month. Well, you've just gone away from your plan. And now maybe you're going to run out of money, or now something's going to happen that you wish didn't happen. So having a really good retirement plan that includes after-tax income, not pre-tax income, after-tax income is really critical to figuring out, A, do I have enough money in retirement to create income in retirement that'll keep me retired? And B, do I have a sense of security, if you will, that it's going to work over time? That's why taxes are so important to comprehend and understand going forward. They go with income, they go with your Part B, they go with Social Security, pension, taxation. What is it I'm going to get after tax every month coming into my checkbook? So that's why we have to really focus on taxes. And I know that a lot of people say, you know, but stop, I don't want to hear it anymore. But, you know, we either manage our taxes in retirement or they're going to manage us.
Yeah. Yeah. And it's funny, Ron, kind of redirecting the attention, and I think properly directing the attention, because people worry, people freak out if there's the possibility of, if they see a 5%, a 10% loss in the market, if there's the possibility of a 15% or 20% drawdown in the market, they freak out. They don't want to lose that money. And yet the way that most people are actually saving in their largest accounts, their 401ks and their IRAs, that loss is already there. It's inherent. It looks like you've got one balance, but you've probably got 20 to 25% less because you haven't paid taxes on that money yet.
Yeah, the embedded taxes in all our tax deferred accounts are really kind of scary if we look at them. So it's always a question, what am I going to do about it? We always think that, you know, it's the best thing to do to say tax deferred. And I would tend to agree with that philosophy. But here's a potential downside. The more tax deferred saving we do, and as our tax deferred accounts, if we're blessed enough with good market conditions for them to grow, we create a larger tax bill for ourselves, particularly once we hit 72 and required minimum distributions become an issue. So if you had a $500,000 IRA and the Lord blessed you with great markets and it went up to 800,000, praise the Lord. Well, you get to be 72. Now that just means you have to take out 3.65% because that's the first percentage for the first year when you're 72, 3.65% of 800,000 as opposed to 500,000. Yeah, you're taking out more, you're getting more money, but you're paying a whole lot more in income tax. Wouldn't it have been a good idea if you'd have met with somebody a few years ago when you had that 500,000, we're trying to figure out how to get it to 8, that you did a lot of the extra growth in tax-free accounts, in accounts that would never be taxed again. So that's the kind of help we can give people. We can say, look, let's plan this together. Let's sit down and say, you're going to retire. For those of you who got 10 years away from retirement, you're really in a sweet spot. You are really in a sweet spot because you have a lot of opportunity and a lot of time to kind of readjust how you're saving for your retirement. Yes, it's important to do it in a 401k and IRA tax deferred. But if you also have in your 401k plan a Roth provision, a Roth 401k, what a great way to save on a tax deferred, tax-free basis. It's like sending tax-free money down the road to meet you 10 years from now when you retire. How cool would that be? You know that when you get down there, you're going to have a big $100,000 savings account that's going to be tax-free forever. Yes, you paid a little bit going forward on that, but it's a great thing to do. So if you have a lot of time to plan, where's the sweet spot in this whole planning? Yes, if you're 40, you have great options. But let's say you're a little older. You've got a 10-year sweet spot. And that 10-year sweet spot is from 62 to 72. That's a great opportunity to try to minimize how much saving you do in tax deferred accounts that are going to be taxed forever, and how much you do using other vehicles, either Roth, life insurance, things like that. It gives you time to help grow that tax advantage or tax-free money down the road. So that's a great option for people. So if this is sounding interesting, give us a call, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there, call us, we'll get back to you. If you want to listen to today's program when it's all said and done, go to our website again, www.cornerstone-rp.com, and click on the blog and you'll be able to get this program entirety. So let's go forward from here.
Great discussion today. We're going to be talking about more tax savings tips when we come back with certified financial planner Ron Corser, re-examining our perspective and our fundamental approach to taxes may help us to reduce, minimize, eliminate, at least control unnecessary taxation into the future, keeping more of our money. And those are the strategies that Ron and the team at Cornerstone Retirement Partners help you to identify. If you would like a comprehensive financial, retirement, investment review, along with that proactive planning tax perspective, pick up the phone and give them a call, 616-301-2581. That is 616-301-2581. More strategic tips when we come back here on Your Course to Retirement with Ron Corser in just a moment.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
And welcome back to Your Course to Retirement with Grand Rapids resource for a common sense approach to planning for your financial, your investment, your retirement future. The team from Cornerstone Retirement Partners providing us guidance and perspective each and every week. And on this edition of the program, we have founding partner Ron Corser, certified financial planner, Grand Rapids go-to resource CFP. If you've got questions or concerns about your finances, about your investments, about your planning for your financial future, pick up the phone and give Cornerstone Retirement Partners a call, 616-301-2581, 616-301-2581. Ron, on today's program, trying to identify and really put perspective on how we can strategically, morally, legally, and ethically reduce our tax liability. The government gives us plenty of opportunities to do so. In fact, there's more tax code that has to do with forward-looking tax planning than about actually filing the previous year's past income. And yet we largely ignore these opportunities, or maybe just fall into one or so category. However, in the red zone, Ron, in maybe the years between about 59 and 72, there's really a whole lot of room for opportunity there.
It really is. And one of the things that sometimes surprises a lot of people is when they get into that retirement mode and they start taking Social Security, that their Social Security can be taxed. I'm not going to go through how they determine that, but it can be taxed. And I go back, my mother was an incredible woman. I loved her dearly. Her whole idea of investing was, let's get the next CD at the bank that pays most interest and gives me a toaster or a waffle liner or something. That's where I'm going. Back in 1996, I had gotten this business in 1994. I finally, and to my detriment, convinced my mother and my aunt to invest some money in the stock market. And 1996 was an incredible year, just an incredible year. 1995 was even better. So what they used to do to fill out their taxes, it was like a big day for my aunt and my mom. They would go to the hairdresser and get their hair done. They'd get their all due, all fixed up. We never knew when my Aunt Helen went to the hairdresser what color her hair was going to be. We used to take bets on it. And then they would go out and have lunch, and then I'd go see the tax lady. I could have done their taxes, in 5 minutes, but they wanted to do them this way, and they always did that. So she called me up at the end of the beginning of 97, and left me a voicemail. And my mom never left voicemails. And it was one of those voicemails, moms can talk to their kids or say their name in such a way that we melt and turn into that 5-year-old kid who's whiny and crying. And the voicemail was, Ronald, you call me. I'm mad at you. And I turned into that 6-year-old kid immediately. I called my mother and I said, Mom, what's wrong? What'd I do? She said, I'm really mad at you. She said, I had to pay income tax. And I said, tell me more. She said, that stupid stock market thing you did, I made too much money and I had to pay tax, and I'm really mad at you. And when I'm done with you, your aunt's going to get on the phone because she had to pay tax too, because that stupid thing. And then they told me my Social Security is going to be taxed now too. So the moral of the story was that she made about 38%. Both of them did that year. But the problem was they had to pay taxes and their Social Security got taxed. The solution, believe it or not, my mother said, I don't want that stupid thing anymore. I went out of it. So I sold it, which created another tax problem the following year with capital gains. So it never ended. But see, that's how everything is interwoven. Everything is kind of connected in some way, greater or lesser. So when we think about, what we have to figure out with taxes, it also can impact what our Social Security tax is going to be. Potentially that could have an impact on what we pay in our Medicare premiums, Part B, or if we have a Medigap supplement, things like that. So there's a lot of things to consider. And always remember that in the final analysis, when it comes to taxes, the Internal Revenue Service, the IRS, is your business partner. I'm going to say that one more time. When it comes to taxes, the IRS, the Internal Revenue Service, or as Barney used to say with Little Abner, the Infernal Revenue Service, is your business partner. So depending on how much you want that partner to take, it really requires that we do a little more planning. And because it's all interwoven, it's all kind of connected together. So what can you do? You can make some decisions right now that basically say, how am I going to allocate? How am I going to fix my income when it comes to taxes? Let's back up and say, number one, think about where your money is allocated right now. There's only 3 possible kinds of investment accounts you can have. One is a tax deferred account, IRAs, 401ks, 403bs, those kinds of things. Another one is a taxable account, 1099 income, investment accounts. They're not taxable in essence that an IRA is, but it's still taxable in terms of interest, dividends, capital gains, And yes, you can write off some losses if you have them. And the third kind of account is a tax-free account. Those are the only three kinds of accounts we can have. It's not any more complicated than that. So if we think about moving money from the IRA, the tax-deferred account, it's going to be tax forever. We can take it step by step and say, I'm going to move some of it into perhaps just a tax advantage account, like a brokerage account. Pay some tax on it, invest it somewhere else. It might be better down the road. Or we can move that into an IRA, Roth IRA account that's tax-free, or some other accounts, that life insurance and things like that. But there's only three basic accounts. So understanding that is the basis for trying to figure out, what am I going to do? If you know what those three buckets are, then you can avoid some of the gotchas. And we talk about the red zone. You know, they have the red zone in football. It's kind of like a red zone here. If we navigate the red zone well in retirement, we're going to pay less in tax and have more money to spend. It's that simple. So how are we going to do this? Understand that when it comes to retirement income planning, it's much different than investment planning. That's a key thing to understand. Investment planning is about what kind of stocks or bonds or mutual funds should I buy to get the most growth or the growth that I want. That really doesn't have a lot directly to do with income planning. We make an assumption that, okay, if I can get the account to go up 7% a year, I can scrape off 4 or 5 and I'm going to be in hog heaven forever, except when the market corrects and it doesn't work so good. Or if I don't make 7% for a couple of years in a row, only make 3%. So investment planning is very different from income planning. Income planning says, I'm going to retire on the 1st of March this month. And I need $5,000 a month coming into my checkbook after tax every month. Where's that money going to come from? Do I take it out of an IRA? Am I applying for Social Security? Do I have a pension? Do I have other investment accounts? What do I have to do to get the money I need every month coming in, so that even if we have a market decline of 30%, I still have all the money I need to live on? That doesn't change. That is a critical planning idea when it comes to retirement planning and income planning in retirement. So that's critical. So understanding the difference between the two is very important, because there are certain kinds of investments that perhaps won't give you the highest possible rate of return, but they'll give you a really nice income flow or cash flow from it. So different investments work a little differently. So are there specific methods of planning to help you prepare to generate income? A lot of it has to do just with the kind of work we do to help clients. When it comes to income planning and retirement, or trying to figure out a retirement plan for people that gives them the income they need, we take a look at a wide variety of investments, a wide variety of places to put their hard-earned dollars so that it gives them the income they need every month. And there's no wrong way or right way to do it. It just depends on what you're trying to accomplish and what you need and what you want and what you're comfortable with. So our goal here at Cornerstone Retirement Partners is to provide a wide variety of options, explain them properly so that you, the client, can make really good decisions on how you want to manage your retirement income. It's critical. So if so far we've done anything that kind of piqued your interest, give us a call, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com, put your information in there, and we will contact you to try to help you.
However, Ron, whether it be in the red zone or any other time, typically investments turn to income when we require income, and there's only so much choice about that matter. We need some income. Where are we going to get it from the investments? However, within that red zone, there are actually reasons why and opportunities we would go above and beyond just the income that we need to maybe reposition some of those investments to better control tax implications and liabilities.
You hit on a pretty good idea there. It really is important. What are we talking about? Once we create an income plan and you have the income you need, then the next question is, okay, I'm going to assume that income taxes and a whole bunch of other things are going to go up. How am I going to respond to that? What am I going to do about it? And the choices are really simple. I can do nothing about it and hope for the best, or I can take advantage of current tax law and try to create a whole new stream of income that's not ever going to be taxed. Here's what I mean by that. We have a lot of opportunity. Once we know how much income we're going to have in retirement, we can figure out in the back of an envelope kind of planning about what our tax bill is going to be for the year. And then we can make an assumption that says, okay, I'm getting $5,000 a month after tax in. I'm in this tax bracket. This is what I'm paying in my real tax. That's my real tax rate. Again, just as a side note, knowing your real tax rate is more important than knowing the bracket. What is the real tax rate? It's very simple. Just take whatever you pay in federal tax and divide it by adjusted gross income. That gives you your real federal tax rate. And the federal tax rate, generally, your real tax rate is lower than the bracket. So then you can figure out, do I have some room above and beyond what I need in income to start? Because I'm in the red zone. I'm in between, as you said earlier, 59.5 to 72, to start to create tax-free accounts, Roth accounts, for example. Or we can put it into a life insurance contract, properly constructed, which will also give us tax-free income and some other things that'll help us going forward in retirement. What can I do to do that over time? And so instead of thinking, oh my goodness, I can't convert $100,000 one time and taxes are going to be too much. No, but between 59 and 72, you've got 12 and a half years. So you can do pieces of this over time. So that when you get to be 72, for example, you have created a pool of money that's never going to be taxed from whatever kind of instruments you're using. That will help you manage taxes in the future. We can show you how to do that when you come in and talk to us about this. We can show you how to manage taxes using tax-free accounts, so to speak. So give us a call. If this is important to you, please give us a call, 616-301-2581, 616-301-2581, or go to our website again, www.cornerstone-rp.com, and we'll get a hold of you. We'll set up a time to talk, either by phone or in person. We can go through some of the specifics of what we're talking about here that apply to you. Now, you're not under any obligation, but we think that once we show you how we can help you, perhaps you'd like to use us on a more long-term basis, and we always welcome that. But the key is to help you. There's nothing that's insolvable about what's going to happen down the road. It's just a question of having somebody kind of stand side by side with you and help you through this. And that's what we do. We'll stand side by side with you and help you through it. Give us a call, 616-301-2581, and we'll help you.
616-301-2581. Ron, you mentioned the process of income planning, and a lot of times this is an unfortunately overlooked, pretty important piece of the total financial and specifically the retirement plan, not only in giving us some level of confidence of how we are going to generate income, how much income we can generate, and where it's going to come from. But if we are looking at income planning strategically, during our working years, if we start this process early enough and are proactive, from the design of the income plan, we can probably draw some conclusions about whether to utilize and take advantage of tax-deferred accounts or whether a Roth is going to be more beneficial. And even if we're already retired, looking forward into that income plan, we may be able to see whether defaulting to the IRS's RMDs or implementing some kind of proactive plan of our own with these Roth conversions ends up being more advantageous for us. So it's not just the confidence of income that results from having that written retirement income plan. We can then draw some pretty important and valuable additional conclusions.
We can, and that's a great point to make. Somebody might say, well, I'm 40 years old. Do I really need an income plan? Because I'm going to work until 65. And my answer is yes. Why is that? Well, there's no guarantee you're going to have your job by next Friday. There's no guarantee that something couldn't happen in the health arena to impact you. It's always good, even if you're 40 years old, to have somebody create an income plan based on a real simple idea. If I can't work anymore at the end of this Friday, what happens to me? One of the things that this kind of thinking has done, particularly on some of our younger clients in the 40s, particularly, they are great savers and they intuitively and overly understand their need to save in a tax-free manner. They understand that taxes are going to go up. They're quite convinced they're never going to see Social Security. They're not going to ever have a pension. They're all on their own. I'm not sure it's that bleak, but that's the way a lot of them look at it. But what they do is they remain very open to how do I save enough in a way that's not going to be taxed and crippled by taxes down the road, so that my family and I can get along in life and look forward to some sort of safe and secure retirement. I mean, it's an interesting mindset when I compare the 40-year-olds when it comes to tax-free saving strategies, and there are several of them, to 65-year-olds. It's much different. I sometimes wish that the 65-year-olds thought like the 40-year-olds. And let's start, in the red zone, let's start making some decisions on how to increase or accumulate more tax-free money. But, human beings are human beings. So we do the best we can with it. But it's really an important idea. Are there certain assets, for example, that are better than others from a tax perspective? That seems like, well, yeah, that seems to make sense. I don't know what they are, but there must be. Well, there are, ladies and gentlemen. One of the ways we help our clients invest in taxable accounts, one simple strategy is to favor more what are called exchange traded funds as opposed to mutual funds. Generally speaking, exchange traded funds, and we can go in, when you come in and talk to us, we can go through the difference between the two, are more tax efficient. So if you're going to invest in a taxable account, costs are important, aren't they? Not only what the charges of an advisor, but the internal cost of that particular investment. So the more you can minimize costs, the more money potentially there will be to grow. So that's another way we can help people, is to create tax advantage, tax efficient investment accounts, taxable accounts that can help with the future. So there's a lot of things that we can do. There's a lot of considerations. It's something we enjoy doing. I'm a bit of a geek. It's kind of like when you take your car to the car dealership, the guy working on it is in hog heaven. He loves working on your car. He always does. He'll do whatever it is you ask him to do. It makes his whole day. We're kind of like that too. When people say, you know what, I need your help. I want you to help create an income plan and retirement that works to minimize taxes, to help me grow the tax amount. It's like we're mechanics. And we get excited about being able to do that because that's what we do. So let me just say this on a very personal basis. If you want to see Nolan, my partner, or me get excited, come and ask us for help. We like doing that. It's what we do. It's what gives us a sense of meaning for what we try to help our clients with. So give us a call at 616-301-2581, 616-301-2581. Go to our website, www.cornerstone-rp.com, and we'll help you.
Ron, you mentioned this a little bit earlier in passing, but I want to circle back to this and sort of reinforce it, that it is not just the tax implications on our retirement account investment that matters. First off, in one of a couple ways, the investment amount is typically very different than the end result amount. So if over the course of our working career, we actually invest $200,000 and it grows to $2 million, we don't owe tax on the $200,000. We end up owing tax on the $2 million. But it's not just the $2 million. It's not the original investment plus the growth. It can actually cause our Social Security to be taxed and our Medicare premiums to be higher if we're withdrawing from those tax deferred accounts. So it's kind of a double and a triple whammy there.
It really is. And that's one of the important things when it comes to trying to figure out income and retirement, is to how do we do it on the most tax efficient manner? And part of that calculation is always, all right, what are we going to do about Part B Medicare if you're 65 or older? And what are we going to do about the impact of our investment decisions, our income decisions on your Social Security benefit? It may not be possible to reduce the taxation on your Social Security benefit, given whatever income needs you have. It may not be possible, but it's always possible to reduce the amount of income you pay now and over time, using whatever strategies are in place at that time that the government gives us. You know, the government gives you opportunities to reduce taxes. I mean, sometimes we hear people complain about these terrible, evil, rich people, and they always have these tax loopholes. But it's not a tax loophole. It's a law that's in the tax code that's created by these people who are criticizing all of these people for tax loopholes. They're the ones who created all this, and it's legal to use them. So why not use them? I have never met anybody, Peter, that said, you know what, when I retire, I want to pay a lot in tax because I really think the government uses my money really good and I trust them. I've never met anybody like that. I think if I did, I'd run screaming out of the office, trying to hide behind a counter or something from that person. So you have a lot of opportunities, strategic opportunities to make some changes in the tax path that we're all on. And we all are on a tax path. It's just a question if we like that glide, so to speak, or if we want to make some changes. So some of the things we can do to help ourselves is we can always contribute more to our retirement accounts. Always find a way to do more. One of the easiest things to do, it is the easiest thing in the world to do, is if you are sitting on a lot of money in a cash account in the bank, earning zilch, is you have the ability, as long as you don't make more than about $200,000 a year, you have the ability to create a Roth IRA account and you can deposit money into it. So for married couples that are over 50, each person can deposit $7,000 into the Roth account. So for a married couple, that's $14,000 a year. And if it's been sitting in a bank account earning whatever it is, 12 cents annually, you can shift that money into a Roth IRA. And at some point in time, if you're comfortable, develop some sort of investment plan that has maybe a moderate amount of risk, but gives you an opportunity to have that money grow. And there's a real advantage now at this time of year in February. Think about this. Roth IRA contributions are kind of unique in that you can make a Roth IRA contribution if you're over 50 of $7,000. And as long as it goes into your account before tax season ends, you can deem that to be a 2020 deposit.
So now we're talking about some real opportunities here, Ron, because if I go to an accountant or a tax preparer who is just looking back at last year and say, how much can I get into retirement accounts? They may tell me $6,000, or if I'm over 50, $7,000, when in actuality, I can do one for last year, I can do one for this year, and I also can double up for myself and my spouse. If I am married, we could theoretically get 4 times that amount into retirement accounts in the next.
What most people do in tax return, and it's very normal, they say, well, if you put $7,000 in an IRA, you get a tax deduction, as long as your income limit allows that. Well, if you have an income limit that's over that, you can't do it. So the next best thing is, let's put it into a Roth IRA. But here's the key. Here's the question everybody has to say to themselves. Okay, I can put $7,000 into an IRA and get a tax deduction right now. How much money am I really going to save on taxes? That's the key question. I know that, let's say I'm at a 20% real tax rate. So if I put $7,000 in there, it's going to cost me $1,400. I'm going to save $1,400. But what if 5 years from now, tax rates change? My tax rate changes. It goes from 20 to 25. So I saved 20% of $1,400 on that money. Now it's going to cost me 25 cents on the dollar to take it out. I saved 20 cents on the dollar going in, Now it's going to take me 25 cents on a dollar coming out. The key question here is, Peter, was that a good decision? And most times tax people, bless their hearts, they are totally focused on reducing our taxes, which is what they should do. But that's a short-term issue. Reducing our taxes on the long term is also an important consideration.
I'm going to throw another wrinkle, because over time, Ron, my goal on my money is growth. So if that money grows over time, that's an even larger bill toward the end that I'm going to have to pay. Even if percentages stay the same, if I'm paying the same percentage on 2 times the amount, it's a larger bill. So just a lot of considerations that need to go into that, crunching those numbers and planning that out.
Do we have time for me to do some arithmetic here verbally?
Real quick. Yeah. We've got a couple minutes left.
Okay. Here's the choice you have. You have $100,000 to keep into an IRA or $100,000 to convert, and it's a 30% tax. So on one hand, you keep the 100,000 in an IRA, it's going to grow at 7%. 10 years from now, it's going to double, it'll be 200,000. You have 70,000 in a Roth because you just converted 100,000. It's going to grow at 7% for the next 10 years. It's going to go up to 140,000. If you're still in the 30% tax bracket, that means every dollar you take out of your IRA, you give up 30 cents, which means 30% of 200,000 is 140,000. So if taxes, the thing is always said, well, that it's going to grow tax deferred. If your tax rate never changes, then there's no harm, no foul when it comes to tax-free money, except it's going to be tax-free. If your taxes change even 1% over that 10 years, you're better off mathematically in the Roth than you are in the IRA. So that's one of the things I tell people. I can show you that on paper, which will make more sense. But I'm obviously a big fan of how are we going to reduce your tax liability, your tax bill, not only today, but 10 years from now. Give us a call, ladies and gentlemen, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. The whole question becomes, how big a partner do you want the IRS to be in your retirement life savings? How you answer that question will determine how we can help you, and we will help you. Give us a call, 616-301-2581, or go to our website, www.cornerstone-rp.com, and we will help you every which way we can, ladies and gentlemen.
Great program today with Ron Corser, the host of Your Course to Retirement and the founding member there at Cornerstone Retirement Partners, to sit down with the team to identify strategies to pay less in taxes and to make your money work as effectively and efficiently for you to help you achieve your goals as possible. Pick up the phone and give them a call, 616-301-2581. Ron, always a pleasure to have your guidance here on the program.
It's been nice talking to everybody. Drive carefully. Here's the good news. Spring is only about 70 days away, I think. So let's pray for that. Otherwise, have a blessed day. Thank you.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the products featured